Imagine a building so massive you could fit 11 NFL football fields inside it. It's state of the art. It's brand new. It was supposed to be the factory of the world 2.0. Now, imagine walking inside that building today. It's silent. It's ghostly. Millions of dollars of inventory, your kids' Christmas presents, your niece's birthday gifts are sitting there, gathering dust in blue plastic bins. They aren't moving. And because they aren't moving, a massive shockwave is currently traveling across the Pacific Ocean, straight toward the New York Stock Exchange. We aren't just talking about plastic dolls and Nerf guns here. We are talking about a geopolitical economic war that just went nuclear. On August 6, 2025, the rules of global trade were rewritten overnight. The United States slapped a staggering 50% tariff on Indian goods. Why? Because India kept buying Russian oil. But here is why you need to care, whether you live in London, Toronto, or Chicago. This isn't just a political spat. This is the destruction of the China Plus One strategy, the very safety net that was supposed to protect your portfolio from inflation and supply chain collapse. If you hold stock in Hasbro, Mattel, Walmart, or any company that relies on global shipping, you are standing in the blast zone. Today, we are peeling back the layers of a $20 million disaster in Bangalore to understand why Wall Street is bleeding, why inflation might be making a nasty comeback in 2026, and why your wallet is about to feel the squeeze of a trade war that nobody saw coming. Welcome to the channel. Let's follow the money. To understand the macro, we have to look at the micro. Specifically, Microplastics Private Limited, located near Bangalore, India. 3 years ago, this place was the golden child of the global economy. The managing director, Vijendra Babu, wasn't just building a factory, he was building a fortress. He dropped $30 million, backed by heavy private equity cash, to create a one-stop shop for toy manufacturing. We're talking engineering, steel mold cutting, production, everything under one roof. At the time, this looked like the smartest bet in the world. Babu's business was doubling every 2 years. He was printing money. Why? Because Western companies were desperate to get out of China. The narrative on Wall Street was diversify or die. So, giant conglomerates like Hasbro, Mattel, and Spin Master rushed to India. Babu was so confident, he built another 250,000 square foot facility right next door. Fast forward to today, December 26, 2025. That new facility? It's empty. The machines never arrived. The lights are off. Instead of dispatching dozens of trucks a day filled with Paw Patrol trucks and action figures to American ports, Babu was staring at a warehouse that is eerily quiet. He's sitting on $20 million worth of stuck inventory. Another $15 million in new orders? Paused. Cancelled. Gone. The culprit is the number 50. 50% tariffs. When President Trump announced these levies to punish India for its energy alliance with Russia, he didn't just tweak a tax code, he erected a concrete wall in the middle of the ocean. Think about the margins here. The toy industry is notorious for razor-thin margins. Retailers like Walmart or Target typically take a third of the final price. The brand takes a cut. The logistics companies take a cut. If you suddenly slap a 50% tax on top of the manufacturing cost, the math breaks. Immediately. The unfinished toys are literally being yanked off the assembly lines. We're talking about half-finished dollhouses and the shells of miniature sports cars sitting in bins, wrapped in plastic, waiting for a trade deal that might never come. Babu was projecting 40% growth this year. Instead, he's looking at a 15% drop and bracing for a depression-level event in 2026. He's keeping workers on purely to avoid layoffs, making products at cost. This is what economic paralysis looks like. But if you think this is just an Indian problem, you are missing the forest for the trees. This is an American inflation problem waiting to explode. Now, I know what some of you are thinking. You're typing it in the comments right now, good. Bring those jobs back to America. We should make the toys in Ohio. I get it. It's a great political slogan. But as financial analysts, we have to deal with cold, hard reality. And the reality is found in the handwork department of another factory owner, Amitabh Kharbanda, who runs Sunlord Toys just outside New Delhi. Kharbanda calls this his trump card. It's a room full of dozens of women painstakingly hand-sewing yellow yarn onto the heads of fabric Elsa dolls from Disney's Frozen. Let's look at the economics of an Elsa doll. It retails for about $60. To make this doll, you need someone to trim the hair, comb it, hand-braid it into a fishtail pattern, sew the beaded dress, stuff the body, and embroider the face. It takes 4 hours of human labor per doll. In India, those skilled workers earn about 20,000 rupees a month. That's roughly $220. Now, let's bring that job to the US. Even if you pay the federal minimum wage of $7.25, which, let's be honest, nobody in a factory works for anymore, you're likely paying $15 to $20 an hour plus insurance and benefits, the math explodes. If you pay an American worker $15 an hour for 4 hours of work, the labor cost alone is $60. That's the entire retail price of the doll. You haven't paid for materials, shipping, marketing, or the retailer's markup. If that doll were made in the USA, it wouldn't cost $60. It would cost $180 or $200. Ask yourself, are you willing to pay $200 for a stuffed doll? The answer, overwhelmingly, is no. This is the uncomfortable truth of the global supply chain. We have spent 40 years outsourcing deflation. We exported the low wages so we could buy cheap goods at Target. Trump's argument that these tariffs will bring jobs back defies the laws of gravity. You cannot automate this kind of intricate textile work easily, and you cannot pay American wages for it without destroying consumer demand. So, when these tariffs hit, the jobs don't come to America. They just die. Or, the price of the goods skyrockets, and the US consumer eats the cost. This is the definition of cost-push inflation, and it's a nightmare for the Federal Reserve. But why is this happening now? Why did the US suddenly decide to nuke the Indian manufacturing sector in August 2025? It's not about dolls. It's about oil. Since the war in Ukraine escalated and sanctions tightened, Russia needed a buyer for its crude. India, needing energy for its massive population, stepped up. They bought Russian oil at a discount, refined it, and kept their economy humming. The US State Department views this as funding the enemy. The tariffs are the punishment. It's a classic carrot-and-stick approach, but mostly stick. However, this creates a massive irony. The US is punishing India for buying Russian oil, but by slapping tariffs on Indian goods, they are effectively pushing India closer to the BRICS alliance and away from the West. Furthermore, look at the supply chain components. Where does India get the eyes for the teddy bears? Where do they get the electronic chips for the noise-making trucks? Where do they get the specialized plush fabrics? China. India's toy industry is still heavily dependent on Chinese raw materials. This is the triangle of trade. China sells parts to India, India assembles them and sells to the US. By blockading Indian imports, the US isn't just hurting India, they are disrupting a supply chain that is still tethered to Beijing. It exposes the flaw in the China Plus One strategy. The idea was that companies like Apple, Hasbro, and Tesla would keep a base in China but open a secondary hub in India or Vietnam to reduce risk. But if the US government decides to weaponize tariffs against the Plus One countries too, then there is no safety. There is no hedge. Corporate boardrooms in New York are looking at this and realizing, there is nowhere safe to manufacture anymore. Uncertainty is the enemy of investment. And right now, the uncertainty index is at an all-time high. I want to take a brief detour to 1930. The US Congress passed the Smoot-Hawley Tariff Act to protect American farmers and manufacturers. They raised tariffs on 20,000 imported goods. The logic was exactly the same as it is today: protect our house. Make it in America. What happened? Other countries retaliated. Global trade collapsed by 66%. It turned a recession into the Great Depression. Now, I'm not saying we are heading for breadlines tomorrow. The economy is different now. But the mechanism is the same. When you artificially inflate the cost of goods through tariffs, you are taxing your own citizens. The Indian government knows this game. For decades, India was the license Raj. They had massive tariffs. They protected their local industries. And what happened? Their industries became flabby, inefficient, and produced terrible products. It wasn't until 1991, when they opened the doors to the world, that their economy took off. In 2020, Prime Minister Modi tried to boost the toy sector by raising tariffs on imports into India. It worked to an extent. Imports dropped, and local exports grew 42% to $571 million. They have a goal of reaching $3 billion by 2030. But that goal is now dead in the water if their biggest customer, the United States, closes the door. India's exports to the US were only $100 million last year. Compare that to China's $11 billion or Vietnam's $3 billion. India is still a baby in this game. They have the labor force, 600 million people, twice the population of the US, but they lack the infrastructure and the deep supply chains. They were just starting to learn. Karbunda mentioned how American companies spent decades teaching China how to manufacture efficiently. He was hoping for the same mentorship. Instead, he got a trade war. So, let's bring this back to your kitchen table. Why should you care about Vijendra Babu's empty warehouse? 1. The earnings miss. Q4 and Q1 earnings for major US consumer discretionary stocks are going to be ugly. If companies like Hasbro or Mattel can't get their product out of India, they miss sales. Missing sales means missed earnings. Missed earnings means the stock price tanks. If you own an S&P 500 index fund, you own these companies. 2. The inflation loop. If these companies do manage to get the product in, they are paying a 50% premium. Do you think they will absorb that cost out of the kindness of their hearts? No. They pass it to you. Expect toy prices, textiles, and potentially clothing to jump 15 to 20% by mid-2026. 3. The interest rate trap. If inflation spikes because of tariffs, the Federal Reserve cannot cut interest rates. They might even have to raise them. High interest rates mean your mortgage stays expensive, your car loan stays expensive, and your credit card debt gets harder to pay off. 4. The domino effect. This starts with toys. But if the US is willing to put 50% tariffs on India over oil, what's next? Pharmaceuticals? India is the pharmacy of the world. A huge chunk of generic drugs in the US come from India. If those get hit with tariffs, healthcare costs rise. Tech support? IT services? The contagion risk is real. This is a supply shock. And unlike a demand shock, you can't fix it by printing money. So, where do we go from here? I see 3 scenarios playing out over the next 12 to 24 months. Scenario A, the blink. The US realizes that these tariffs are hurting American consumers more than the Indian government. The diplomatic channels open up, India agrees to reduce Russian oil purchases slightly, and the tariffs are rolled back. This is the bull case. If this happens, Indian manufacturing stocks and US retailers will rally hard. Scenario B, the long winter. The tariffs stay. The trade war deepens. Supply chains fracture permanently. In this scenario, companies like Sunlord and Microplastics have to pivot. And they already are. Carbunda and his competitors are doing something remarkable, they are pooling resources. They are renting shared factories, buying laser cutting machines together to replace manual labor, and automating what they can. They are preparing for a world where they have to be leaner and meaner. Scenario C, the internal pivot. This is the most interesting one. India has 1.4 billion people. 350 million of them are children. That is a market larger than the entire US population. Carbunda said it best, Plan A, tariffs go away. Plan B, expand to other markets. Plan C, focus on India. As India's middle class grows, these factories might just stop caring about the US consumer and start building for the Indian consumer. If that happens, the US loses its leverage, and we lose access to cheap labor permanently. That means higher prices for us, forever. What should you do? 1. Watch the retail sector, be very careful with consumer discretionary stocks that have heavy exposure to India right now. Read the 10K filings. See where their supply chain is. 2. Energy hedge, this dispute is rooted in oil. Energy stocks continue to be a hedge against geopolitical instability. 3. Diversify geography, don't just bet on the US. Look at markets that might benefit from this chaos, potentially in Southeast Asia that might escape the tariff wrath for now. The empty warehouse in Bangalore is a monument to a changing world order. For 30 years, globalization meant find the cheapest place and make it there. That era is over. We are now in the era of geopolitical manufacturing, where you make things matters just as much as how much it costs. Vijendra Babu and Amitabh Carbunda are resilient. They are entrepreneurs. They will likely survive by pivoting to their local market or automating their way to efficiency. But for the American consumer and the Western investor, the lesson is harsh. The days of endless cheap goods, powered by frictionless global trade, are vanishing. The walls are going up. And every time a wall goes up, your purchasing power goes down. Keep your eyes on the supply chain, and watch your portfolio closely. The Toy Story is just the beginning. Thanks for watching. If you want to understand how the oil markets are driving these decisions, check out this video here. And don't forget to like and subscribe if you want to stay ahead of the curve. I'll see you in the next one.